So before we dive into today's discussion, I'm joined by Laura Wilson, partner in the corporate team at Cripps. Welcome, Laura.
Hi, Gary.
Hi. Well, Laura advises privately owned businesses and private equity groups on a wide range of mergers and acquisitions within the insurance sector. And more recently, she's expanded her expertise into the wealth sector for acquisitions as well. And this gives Laura a particularly strong vantage point on the nuances and challenges involved in buying and selling IFA practices. Laura, would you mind just sharing a little bit more about your experience in this field?
Of course, yes. My background is I qualified as a lawyer back in 2015. So I've been with Cripps for more than 10 years now. My practice has always been focused on corporate M&A mid-market transactions. And as Gary said, I started having a real sector specialism in the insurance sector many years ago. And that's recently expanded into the wealth space. So um, lots of experience in recent years buying and selling IFA businesses, and really enjoying sort of the time I'm now spending in this space, and building our network, and supporting on transactions.
Fantastic. Well, I think everybody would agree that's viewing this that Laura is an absolutely brilliant person to be included in today's discussion. Today, what we're going to be talking about really is looking at what goes wrong in IFA deals from both a specialist broker point of view and also from a specialist solicitor point of view, and how to make sure that doesn't happen to you. So, Laura, tell me what you find are the most common reasons why IFA deals fall apart.
Yes. In my experience, there's different reasons why a transaction might not get over the line. But what we tend to find the most is uh, the main reason why things might become a little wobbly, is that a seller will reach quite an advanced stage of negotiations, and it will dawn on them i- what they are entering into,
Yeah.
what was once theory and becomes very real, and they have a really clearer picture of what the transaction itself looks like. They get to a point where they understand more about the detail, more awareness of risk and liability moving forward and going into the deal.
And just thinking about that, I mean, we tend to see, the sale and purchase agreements can go into 100 pages, and then suddenly all those restrictive covenants, the indemnities, it becomes real, doesn't it?
It does.
And a little bit more frightening. And I'm not surprised that that's where you would see that. I guess as a broker, we sometimes see some wobbles before we get to that point
Yes.
because it's in that earlier stage at the offer, the heads of terms, and then you really come into your own then once we've gone past those heads of terms when it gets into the legal detail.
Yeah.
Yeah.
Yeah. So really, my job throughout the transaction is to coach sellers through these
Yeah.
risks and help them understand what the detail really means to them, and help them to be able to process the complexity of it, and to see issues in the round, and to guide them through that, and to try and ensure that you can get the transaction back on track. And we do find that you can help take sellers through this emotional journey,
Sure.
that is the sale process,
Yeah.
and we can get the deals done in the right way for them.
Yeah, I totally right. And of course, and the other aspect is that you're starting to see that they're going through that due diligence stage as well. And questions are being asked about file checks and
Yeah.
also past advice, etc. And from the due diligence on financials, all starts to become very real now, doesn't it?
It does. It's a very overwhelming process. We're talking here about owner-managed businesses. So
Yeah.
we're dealing with individuals who are trying to keep on top of their day-to-day
Agreed.
business needs
Yeah.
whilst running a transaction. And as you'll know, there's certain pinch points throughout the transaction where a lot of time and energy is needed from sellers, and they need to, really commit to the transaction. So it's a journey for sellers to go through.
It certainly is. And there's a difference between financial and emotional blockages there as well, isn't there?
There it is.
And we tend to sometimes find that, that's when a seller will start to question, do I want to sell? Am I ready to start to retire at this stage? Should I carry on? And maybe I give it another year, 2 years. Some suddenly want to stay on for another 5 years, and think, where did that come from? I think that emotional side sort of kicks in.
It really does. There's a lot of big thinking to be done as you navigate your way through. And I think it's only natural. It's a huge thing to sell the business, or a business that you've grown and invested all of your time and energy
Yeah.
into. And you really want to make sure that you're doing it on the right terms, and in the right way, for yourself, for your family, for your employees. So it's critical to get all of these things right and to have the right guidance along the way.
And I think you've hit the nail on the head there. The right guidance is making sure that you're talking to the people that understand these type of deals
Yeah.
and what is expected, and to help guide them through it as well. And it's so important, I think, that we keep that momentum going,
Yes.
because deal fatigue really
It
comes into play sometimes, both on the seller and the acquirer, that if things aren't moving along speedily enough, the deals can sometimes fall apart that way.
yeah, it really is important to get some traction from day one, and
Yeah.
to just move at a good tempo so that you get through that process without it becoming unnecessarily painstaking. um there's certain things that need to be ticked off the list as you
Yeah.
make your way through. But I think if you can just keep that momentum, as you say, um it's helpful for everyone involved, and it does help as well with the emotional side of things,
I,
because
I totally agree.
you're then carried through the deal cycle.
We're,
Um,
we're working now with some really great acquirers that I think understand that that needs to be communicated. It needs to almost have that sort of chart of what's expected and when things are going to happen.
yeah.
And most deals can happen quite quickly, and we can get completions within a 3 month period. But it's usually down to the seller. Is the seller ready to give all the information? Because generally speaking, those acquirers can, do their due diligence quickly.
Yeah, acquirers can mobilize. They are well versed in M&A, and they have deal teams dedicated to the
Yeah.
process. So typically, an acquirer will be ready to go and responsive, and able to meet up with the demands of the transaction. For a seller, it's understandably harder to create the time and the energy, but you do need to commit to a transaction. And that's where we do find that with the right preparation, you really can set yourself up for success in these transactions.
Agreed, agreed. And I think sometimes it's also delegating some of that responsibility to others as well. And
Yeah.
that does help within the team.
Yeah, and let your advisors help you. Use the team around you to help you deliver that transaction successfully. I think the takeaway for me is it doesn't have to be painstaking. There is a way to do these deals quickly and sensibly.
Yeah. And we appreciate that sometimes some of those sellers don't want to involve the team at that earlier stage,
Yeah.
but the more that they can and be transparent, then I think those deals do go through a lot easier, don't they?
They really do. So, Gary, how much, in your view, does market volatility actually impact on deals and deal decisions?
Well, it does affect some more than others, I would say. For a small number of people, when the market just recently, we've had, the Iran war, and the market's dropped a lot between February and March, and that has, for a couple of our sellers, made them question whether the timing is right. Big problem is you never know, how to time the market, and IFAs have been telling their clients that for years. Yeah, you just can't time the market. But history shows that these dips, they bounce back, and they bounce back relatively quickly and often then become stronger.
Mm.
I mean, if I go back to like the referendum, it suddenly changed, that there was a big dip, but the market recovered. Then we have Brexit dips, and then we have, the Russia and Ukraine, again, another dip. These things do happen, but for the bulk of the sellers, if the fundamentals are right in the business and the recurring income is there, the client demographics, etc., the deal all stacks up over that period. We very rarely find that a deal comes out lower on the end consideration value because of market fluctuations. But there'll always be a couple and do that wait and see. And I think then it suddenly becomes all those emotional factors. Should I really be selling? Should I just
Mm.
wait and see? But you just don't know what's coming around the corner, and you could be just waiting for a worse position.
Yeah,
Um,
yeah, precisely. I couldn't agree more. And from what I see in the transactions that we work on, is there can be lots of noise in the market,
yeah,
disruption and different things happening. But it's almost secondary to the deal itself and the deal that's on the table. As you say, if you have a fundamentally strong business and a well run advisory firm with strong client retention, good recurring revenue, clean compliance history, then really, from a buyer's appetite perspective, than what's going on in the rest of the world, um, it might influence some of their appetite around risk
yeah.
or how they approach structuring a transaction in terms of the spread of consideration and initial consideration versus deferred consideration and the split between the two. But ultimately, what I see in the market is the deals still get done on the same valuation basis, and
Yeah.
there's not necessarily a direct impact on multiples and valuation. We're still seeing lots and lots of deals successfully complete in quite turbulent market.
And not forgetting that really, a lot of the time, the basis of the valuation has been done on the previous 12 months
Yeah,
anyway. So often that's at the better performance. And then the deal will review itself over the next 2 or 3 years, depending on the deal terms. And generally, it smooths itself out.
yeah, and buyers price in risk and volatility. So it's all built into the deal itself. You can see some of the larger acquirers have to maybe move a bit more slowly in really rocky times. There
Yeah.
might be increased need for more internal sign-offs and consents and things like that. So sometimes there's an impact on deal timetable. But generally, I wouldn't expect deals to fall over or to not get done or to be being done, but at much lower price points.
I think the other risk here I see, Laura, is on an acquirer, they've normally secured funding.
Yes.
Yeah, whether that's equity or leveraging finance. And once it's there and available, if somebody pulls out of the deal, then often that deal will get replaced by another deal. So there's no guarantee that the deal will still be there. And if you loved everything about the deal, those fundamentals, then you're possibly having a greater risk by delaying.
Exactly that. And, none of us have got crystal balls. We don't know what the future holds. If there is a deal that stacks up commercially for you, and it's in front of you, and the only thing that's holding you back is external market factors, then I think there really is merit in seriously
Yeah.
considering what's in front of you in terms of that offer.
Absolutely right. And if during that period the market has dropped, when you come to sell, if you've waited those 2 years, then your business is going to be worth less. So,
Yeah.
I don't mean worthless. I meant this will be worth less.
Yeah. But I think even well-run advisory businesses, have a natural loss attrition rate over time, and
Yeah,
the demographics within client books change.
it is indeed.
So, there are statistics to show that over time, um, there will be a negative impact on revenue or assets under management. So it is sensible if there's a transaction that works for you in all key respects, and um, otherwise stacks up, putting aside some market
I'd agree.
volatility, than to continue as you were before.
Exactly. I'm a great believer that you'll never get it 100% right, and if you're more than 80% right, then it's a good,
Yeah,
deal to be done.
I think that's a good rule of thumb. So, what are the risks of IFAs delaying a sale to maintain income?
Well, I think the actual main risk is that if an advisor, a seller, is looking to delay for 2, 3 years, is not forgetting that their client bank is also aging as well, and that can actually affect the outcome of the price on the consideration value. I'll give you an example. If you've got a client bank with an average age of, say, 66, it will be valued more than a client bank with an average age of 69. And that would naturally happen. And the reason for that is some various things here, is more clients will go into decumulation.
Yeah.
So that means decumulation is a shrinkage of the funds under management. Some of the clients, unfortunately, may die in that intervening period and come off the books. And some others, all others, I would say, is that longevity of life will be reduced by that number of years of delay. So that's one aspect. The other aspect is often when an advisor seller is looking to delay that sale, they sometimes lose that momentum, that growth. And I hear it so often. I haven't done any new business. In fact, I don't really go looking for it at all.
Mm.
And the issue there is that acquirers are looking for those client banks that have been regularly serviced, and there's a lot there. So I think in lots of ways, the seller doesn't realize that the value can drop, and it's actually increasing the risk.
Yeah, so it can be short-term gain, but
Yeah.
possibly losing out in the longer term in terms of overall valuation.
And a lot of sellers do think, well, let's just say we're getting a 4 times recurring income as a
Mhm.
multiple. Well, if I kept the business going for 4 years, I would have got that anyway. However, revenue and take home net pay of tax is very different.
Yeah.
Yeah. And it's also important to remember that that consideration value is going to be taxed at the most efficient rate possible, hopefully getting business asset disposal relief,
Mhm.
yeah, which is currently 18%. And anything that falls over that after the £1 million a lifetime allowance there will go into capital gains tax at 24%, which is much better than if you've got a corporation tax at, say, 25%, then taking out dividends as a higher rate
Yeah.
dividend. So it's unlikely. And of course, you're going to have a lot of overheads as well. And I think it's also important, especially for businesses that have got more advisors or support staff and they want to keep all of that on. It is the profit that is the most
Yeah.
important. Yeah. And if those businesses aren't going to continue to generate as much in the future, then it will contract in the consideration value.
And buyers are, of course, most interested in targets which have got strong prospects in terms of ability to scale and grow.
Correct.
So those more younger books are
It
more
is true.
attractive. Yeah.
Absolutely. And some clients, when they get over a certain threshold, and acquirers will all vary on this, but in essence, those that are over, say, 75 will have a lot lower multiple. Those over 80
Yeah.
may not even have a multiple at all, etc. So be careful that you're not actually going to be financially benefit from it, but also is just think about your own goals in life,
Yeah.
to add on another 2, 3 years in retirement, you know, what's life about really is.
Yeah. Succession planning. But no, it is interesting, isn't it? And I think there are clear stats that support, even the most well-run of advisory books will naturally, have a loss attrition rate over time because of these factors and
Yes,
the inevitable changes to the demographics of their clients. Serious consideration does need to be given to
absolutely.
waiting and to hesitating because um, you will benefit from the income, as we've said, but um, longer term valuation could be
Well,
negatively impacted.
it certainly can. And that compound effect, just losing, say, 5% of the revenue each year, after a couple of years, it's likely that your consideration value may be lower by about 20%. So, did it
Yeah.
really serve the purpose what was expected to?
Yes.
So, Laura, what are the most common legal pitfalls that vendors face?
So there are a couple. Um, so if we look at the outset of a transaction, so there's often a lot of value add actually that I think the right advisor, the right legal advisor, can add at the very beginning, at that heads of terms stage.
Yes.
Lots of sellers might approach heads in a very relaxed manner. Um, you know, Majority of the document is non-binding,
Yes.
but it's a really great opportunity to drill into key commercial terms and to iron out um, various points that might or are likely to crop up later in the transaction. So, we find that SPA negotiations run far more smoothly when real time and consideration has been committed to heads of terms, because then you really are um, just rolling out essentially what's in your heads, and you've got this great guide as to each party's position on key legal points. So it's a good time for parties to come together and to work through key issues and structuring points, and to think about any hurdles or issues that might crop
Yeah.
up during the course of the transaction, and to preempt those issues and to do things at the earliest stage to ensure a smooth process later down the line.
And I totally agree with you. And I think sometimes, the danger of a very brief heads of terms is not covering enough. Yeah.
Yes.
And then we can have those problems at the SPA level. However, on the flip side, we have seen some wanting to put so much minutiae into those
Mhm.
heads that really is saved for the SPA.
Yeah.
And it's getting that balance right, isn't it?
It's precisely that. It's a balance. It's focusing on the key points. There is inevitable detail that will
Yeah.
follow in your 100-page SPA,
Yeah.
hopefully shorter. But yeah, just creating that framework is helpful, and it focuses the mind. And if there are any key points around liabilities or risks, it's a great time to put them on the table and to manage them.
Yeah. And I think it's those earn out calculations as well. Needs to
Yeah,
be shown, doesn't
yeah.
it? High level, what's going to come back as clawbacks, etc., and the covenants as well.
Absolutely. As a seller, use it as an opportunity to really wrap your mind around, how the deal will be structured and what it means for you, and work through your questions, any key points at that stage. So, in terms of other quite common legal pitfalls, um, what I often come across is sellers who are introduced to a variety of new legal concepts that they haven't come across before.
Yeah.
So, things like disclosure, indemnities, and so on. So, I think it's really helpful for a seller to be given an overview of how the transaction will play out and what these different concepts entail and what they mean to a seller legally from a risk perspective. So I'll always try and go through that at the earliest opportunity. Um, and I think once a seller understands, why disclosure is important and
Yeah.
what role it
And making
plays.
sure there's sufficient in the disclosure as well,
Yeah,
isn't it? Because
yeah.
that's a seller's protection.
Yeah, it's a huge barrier to claims from a seller's perspective.
Yeah.
And there's real merit in approaching that exercise properly and thoroughly. And I tend to find that once sellers understand the benefit to them in the exercise,
Yes.
then
It's not all one way, is it? This
no,
is this
yeah.
is not about just protecting the acquirer.
Yeah, this is, it's a seller's opportunity to say, look, these are the matters, the issues within our business which contradict with those warranty statements. So
Yeah.
we as seller will give you these contractual comforts, but they are subject to you knowing these things that we are now about to tell you within the disclosure letter. So it's really just an education piece, I think,
Agreed.
at the outset to make sure that you approach these different hurdles in different ways.
And I think it's also to look at the professional indemnity, the runoff covers as well, and
Yeah.
how that they can play a part. And so, is it just an excess that the vendor is actually going to be liable for the full extent, isn't it?
Yeah, the interaction with the risks that come with the M&A transaction and existing insurance policies. There's lots of intricacies with these points, and it's just about navigating them as you work your way through the deal.
Agreed. And I think comfort really for the vendors, particularly, you've got a completely clean track record, no complaints, no redress. That should give you comfort that you can give a lot more in terms of those indemnities as well. And also, is how long is the entity going to be around? Now, some obviously may have a change in control and may stay forever. But at what point, how many years are those warranties and indemnities going to stay in place? And other times it's, if the company is going to be um, solvently liquidated, then that liability then ends at that point. So it's knowing when things stop, isn't it?
Yeah, it's all about fair allocation of risk between the
Yes.
parties, and making sure that there's no unfair exposure on one part and not the other. And that's really a huge part of my job is to make sure that that allocation is right, and to talk sellers through, the reasons why a buyer might be asking for certain protections, and the rationale behind it, and what committing to those protections, whether they're by way of indemnities or warranties, really means to a seller in real terms, and making sure that that risk is understood and accepted. Um, so there's lots around that as you
Yeah.
work your way through, as you'll know.
And I think the great thing, Laura, is working with people like yourself that understands, yeah, that an IFA acquisition is very different to an acquisition of lots of other types of businesses, particularly around the past risk. yeah,
Yes.
of advice. And it's you knowing what's expected and being able to communicate that to a vendor. And sometimes, unfortunately, if the professional advisor doesn't have that experience, it can cloud everything because everything is like, this shouldn't be in here. Well, it should, because these deals won't get done without it.
Yes, in these type of transactions, there's quite customary warranty and indemnity packages, and they will always cover typical and predicted risks.
Yeah.
We know the nature of those risks because we understand these businesses, and so you can almost predict,
Yeah.
where the buyer will be seeking its specific coverage. And the huge value add that advisors can bring when they've worked on these transactions before is being able to focus on the right aspects of the contract, and not coming at negotiations from an angle where you might not recognize what is quite market really,
Yes.
in these type of transactions. So that I like to think that we can add value in that sense, because we can
Definitely.
give a good degree of comfort to a seller in informing them on what is a normal and expected ask from a buyer, and then flagging also where something might be slightly left field and not so reasonable.
Absolutely right. So, Laura, one of our frustrations in life is when a seller uses a general solicitor to act for them. Um, and it's very difficult for us sometimes because, it may be one of their best clients and they've trusted them with all previous transactions. But we it's just the difference of not understanding what an IFA acquisition does and all that legal um, covenants and warranties and indemnities. So I'm going to ask you, because you must get this also from being on one side of the fence.
Yes.
So tell us, what do you see as being the issues of using a general solicitor as opposed to a specialist solicitor in this field?
Yes. So you do see it from time to time, and it's completely understandable in certain scenarios because there are trusted relationships in play at times. So you really can understand why you get to where you get to. Um, from our perspective, it can give rise to issues, and really the main issue is that you end up in very protracted negotiations on occasion because what features in these contracts, um, in terms of being quite standard from our
Yeah.
perception as positions that you will ordinarily see in an IFA deal. Um, some advisors who aren't as familiar might not detect them as that. And so you can end up having lots of negotiation about quite market standard positions.
Yeah.
So I think the huge benefit in having an advisor who is experienced in IFA deals is that they really can focus your mind on the real points that require consideration, and everything else can sort of be neatly dealt with, and it stops the process becoming unduly onerous, and it really does make sure that you are focused on the key issues that matter and that you deal with those issues properly. um, and I think being able to streamline negotiations in that
Yeah.
way just helps build momentum as you work through the deal. It stops you becoming stuck on completely irrelevant points.
Yes.
And that has just so many benefits because it's really important as you work your way through these transactions to maintain a good relationship with the other party. So you don't want any sort of friction or tension coming into play because you're sort of picking points that don't need to be picked up on. And it should help manage costs. It should mean that you get to where you need to get to um, smoothly, with fewer headaches. It's great when you have the right advisory teams advising on these transactions, because it really means that you can enjoy the transaction
That's
and you can get to completion
We
without
often
multiple turns.
we often feel it's like you're not seeing the wood for the trees. You're covering so many different random things that really shouldn't be even questioned here. But actually, are you picking up the more important factors in doing that? And you're absolutely right. And cost does increase because there's more and more solicitor involvement on both sides.
Yeah,
And it can it can slow the process down,
it can.
and it can kill deals, unfortunately.
Yeah, I think there's a time cost, there's a financial cost, and then there's the risk piece.
Yeah.
And it is important to make sure that you are focused on the issues that really matter. And having commercial, pragmatic, experienced advisors will help you get to that place.
I think it's like owning a supercar, isn't it? You're not necessarily going to take your Aston Martin to be serviced in a garage that hasn't actually serviced those cars before. It is a specialism, even though that mechanic understands cars. Yeah.
Yeah. There's just sector specific points that
Yeah.
creep into these transactions, and play quite a key role. And being able to navigate them really does matter.
And I think that's really important for us. Why we like working with people like yourselves, Laura, is because, it just gives the real focus and actually added protection to the sellers on there, and acquirers too. That we want
Yeah.
both sides to have, suitably qualified specialists.
Okay. So, what's one piece of advice you'd give to an IFA considering a sale?
I would say don't wait for the perfect moment because it's never necessarily going to be perfect. But if the fundamentals are there, yeah, and they're strong, your business has real value. And also, are you emotionally ready for this sale? Because once you're emotionally ready for the sale, then everything else will come into play.
Yeah, I completely agree. Um, for me, I think um, I'd have to say it would be to get the right advisors around you. Instruct the right advisors to help you find the right home for your business, to make sure you receive the right value for it.
Yeah.
And then the right advisors to actually take you through that process and help manage your risk, and to help ensure that you can achieve the exit that you need in the right way.
Yeah, absolutely. And for us, if we looked at timing, we would say that if you are thinking of a sale, then start talking to us now. Even if it's 2 years down the line, we talk to lots of sellers and are able to give them quite a lot of good tips of how to prepare their business for sale.
Yeah.
Um, Having said that, again, that emotional readiness, if you're ready to sell,
Hmm.
yeah, we can look at the type of business you've got. We'll make sure that we're making the right introduction so that you don't necessarily have to wait. If you're emotionally ready to sell now, we can look after that sale and get very good outcomes as well.
Yeah, it's never too early, is it, to start preparing?
No, not at all.
And from a legal perspective, making sure all of your housekeeping is in order, is always beneficial. Um, so so yes, I think the earlier the better, really.
Fantastic. Laura, I'd like to thank you very much for joining me on today's discussion and looking at the pitfalls sometimes that we experience and to help any sellers that are embarking on a sale to hopefully avoid
Yes.
reaching those. Love working with you. Want to continue to do that. And please do like this YouTube video and make sure you subscribe so you don't miss the next in our series.